Hello and welcome. In today's video, we're exploring the essential techniques you need for effective financial statement analysis. If you want to make smarter financial decisions, whether as an investor, professional, or business owner, understanding these methods is crucial. These techniques open the door to interpreting complex financial reports and turning raw numbers into business insights. Let's take a quick look at what we'll be covering. We'll start with the basics of reading financial statements, then move into proven ratio analysis techniques that turn numbers into actionable information. After that, we'll dive into cash flow statement analysis, a fundamental skill for any financial leader. We'll review vital performance metrics, understand the importance of financial statement audits, and explore consolidated statements and segment reports. To round out our session, we'll discuss forecasting and benchmarking methods to help you plan strategically for the future. Let's begin with the critical core: how to read financial statements. At the heart of financial analysis are three key financial statements: the balance sheet, income statement, and cash flow statement. The balance sheet is like a snapshot, revealing what a company owns and owes at a specific point in time: assets, liabilities, and equity. The income statement, in contrast, tells the story of profitability by tracking revenues and expenses over a period. And importantly, the cash flow statement monitors the movement of money through the business, showing where cash comes from and where it goes. When you analyze these statements together, you gain a well-rounded understanding of the company's health. This is essential for both regulators and executives seeking to make informed, strategic decisions. Next up, we'll see how analyzing ratios from these statements can unlock trends and signal where a business is thriving or struggling. Ratio analysis is one of the most important tools for interpreting financial statements. By looking at ratios, we can benchmark a company against its peers, track performance over time, and catch issues before they become problems. Let's break it down. Strategic benchmarking means comparing financial ratios over different periods or against industry standards to inform decision-making and guide planning. Liquidity and leverage ratios help you assess whether a business can meet its debts and how stable its capital structure is. Efficiency ratios show how well assets are generating sales. Leverage ratios reveal the extent of company borrowing and financial risk. Finally, profitability ratios help clarify operational strength and overall stability. Metrics like net margin, asset turnover, current ratio, and debt to equity all paint a detailed picture. Now that we understand what ratios tell us, let's move on to cash flow analysis, an essential indicator of true business strength. Cash flow analysis reveals much more than just whether a business is profitable. It uncovers its ability to survive and grow. This process starts with the preparation step: gather and structure operating, investing, and financing activities. Companies may use direct or indirect methods to calculate cash flow. Next, we move to analysis. By comparing cash flows period over period, you can spot patterns and anomalies that tell you about operational drivers, investment results, or the effectiveness of debt strategies. Interpretation is key. Here, the aim is to connect the sources and uses of cash with business strategies, revealing how day-to-day events impact the bigger financial picture. Finally, reporting is about translating all this into clear findings, management reports, and regulatory filings that highlight liquidity strengths and any emerging risks. With a grasp on cash flow, we're ready to understand which metrics are most important for tracking overall performance. Some financial metrics rise above the rest in importance. These headline numbers provide fast insights into both current health and long-term sustainability. Take net profit margin. It shows how much profit the company keeps from every dollar earned, after all expenses are paid. If this margin is strong, operations are usually efficient. The current ratio measures liquidity, making it easy to see if the company can pay its short-term liabilities with its assets. A healthy number here means less risk of financial distress. Return on equity is a key indicator of growth potential, showing how well management is generating profit from shareholder investments. By regularly monitoring these metrics, you can quickly gauge how competitive and sustainable a company is and spot opportunities or risks early. Audits aren't just a formality. They build trust and reinforce operational discipline. They've got three main components. First, audit outcomes. These include not just reports, but also management letters and suggested improvements. An open exchange between auditors and management helps identify risks and maintain transparency. Next is risk management. Auditors plan tests based on business risks and regulatory requirements, using sampling and other tools to produce reliable, actionable results. And then there are internal controls. Auditors check systems and balances thoroughly, reviewing the processes behind the numbers to make sure everything is sound. External audits, in particular, add credibility for investors and lenders alike. Ultimately, strong audits mean you can trust the financial statements you see, reducing mistakes and protecting stakeholder confidence. When discussing larger or more complex organizations, consolidated statements and segment reporting offer deeper perspectives. It starts with an effective reporting process, gathering solid data, ensuring consolidation and segment details meet global standards, and supporting robust audits. Transparent disclosure is incredibly important. Segment data reveals specific risks and opportunities linked to markets or resource allocation, serving both compliance and strategy needs. Segment detail goes deeper, breaking financial results down by business unit, product line, or geography. This helps management and investors make informed decisions about allocating resources. Finally, consolidated statements knit everything together, combining results from the parent company and its subsidiaries and removing intercompany transactions. The result is a comprehensive view for all stakeholders. This powerful level of detail brings clarity to performance, risk, and opportunity. Looking forward, strong financial analysis helps set goals, manage risks, and drive improvement. It begins with budgeting fundamentals. Developing realistic budgets requires a careful study of historical results, market trends, and anticipated changes. It's essential to keep your benchmarks updated to monitor how actual performance tracks against forecasts. Next are forecast techniques. Scenario analysis, regression, and trend modeling enable robust projections, stress tests, and plans for risk mitigation. Finally, benchmarking provides the context for evaluating how well a business is performing relative to the competition. This insight helps leaders guide strategic initiatives and focus on areas that need improvement. Let's now see how these processes combine into a continuous loop for real financial progress. The most successful organizations treat forecasting and benchmarking as an ongoing process, one that's structured, efficient, and continually improving. It starts with preparation. Gather essential data, clarify the objectives, and assign responsibilities for each forecasting or benchmarking activity. The next phase is execution. Use both quantitative models and qualitative reviews to produce accurate projections, track results, and spot significant deviations. Assessment follows, where you compare actual results with forecasts, spot areas needing improvement, and adjust your planning accordingly. Finally, continuous improvement is the goal. Refine your techniques, refresh benchmarks, and adopt best practices to keep enhancing your financial management. Ultimately, regular evaluation and iteration are what elevate financial performance and enable smarter decision-making over time. Let's wrap things up. Staying up to date with regulations, trends, and new analysis techniques is vital for driving performance and maintaining compliance. By consistently applying ratio, benchmarking, and segment analysis, you're not just meeting basic standards, you're uncovering valuable opportunities for improvement. Accurate and timely reporting is fundamental. It's the foundation of sound management decisions and stakeholder trust. A strong analytical foundation means you can transform financial statements into powerful tools for strategic leadership. Thank you for joining this complete walkthrough of financial statement analysis. If you found this helpful, please like the video and subscribe for more in-depth financial insights. See you in the next session.